Hey guys, Joe Massey here with Castle & Cook Mortgage, and today is Friday, June 27th, and this is our third part of our three-part series talking about mortgage insurance. Last week we talked about FHA mortgage insurance, and today we're going to talk about conventional mortgage insurance and how this applies for your customers. So the first thing to understand about conventional mortgage insurance is that you will have mortgage insurance if you put down less than 20%. Now the types of mortgage insurance are going to vary. It's going to vary pretty significantly depending on the FICO, the down payment, the property type. Lots of different variables go into it. You guys remember from FHA, it's pretty standard. There's really only a few changes in mortgage insurance on FHA loans, but conventional, there's going to be a lot of fluctuations depending on these different variables. Common down payments on a conventional loan are 5%, 10%, 15%, and obviously 20% down. An important thing to keep in mind too, if you're putting down less than 20%, your loan will have mortgage insurance in one form or another. Many lenders are out there advertising, all right, we've got this 5% down, no mortgage insurance, 10% down, no mortgage insurance. It's important to understand there is mortgage insurance on those loans. The difference is whether or not the customer knows about it and whether or not it's being disclosed to the customer. So it's really important. We're going to cover that in this presentation today on how mortgage insurance works on different scenarios. But if you're not putting down 20%, your loan does have mortgage insurance. So what are the types of MI? Of course, there's monthly mortgage insurance, which is what we're most familiar with. There is upfront mortgage insurance, which I think is a great option. Then there's also lender-paid mortgage insurance. This is probably the most common where folks say, hey, there's no mortgage insurance. I'm going to show you guys how that works. So monthly mortgage insurance, of course, will go away once you reach 78% loan to value. You can always call the servicer once you reach 80% and have it removed. But if you forget to call once you reach 80%, it will automatically go away once you reach 78%. So that's an important distinction as compared to FHA mortgage insurance that we reviewed last week, that will generally have mortgage insurance for the entire life of the loan. All right, so let's look at a 30-year loan with monthly mortgage insurance. How does this work? First off, the upfront dollar amount is zero. You'll remember on FHA, you have upfront mortgage insurance and monthly mortgage insurance. On conventional, you don't have that. You kind of pick one or the other. So upfront is zero. There's no upfront mortgage insurance. Your monthly is going to range, again, depending on the variables of credit score, down payment, etc. It could be as low as 0.35% to as much as 1.1%. And that's an annual premium that'll be paid on a monthly basis. So let's look at a sample scenario. $200,000 purchase with 5% down, which is a very common down payment. That's a $10,000 down payment. Your principal and interest would be $948 per month in this scenario. Average monthly mortgage insurance for this scenario would be 0.59%, which is about $94 per month. So the total monthly mortgage payment would be $1,042. All right, so that's scenario number one with monthly mortgage insurance. Let's look at an option with upfront mortgage insurance. So our upfront mortgage insurance is going to vary, again, depending on those same scenarios. Down payment amount, credit score, etc. So it's going to range anywhere from 1.7 to 3.65%. Monthly mortgage insurance in this scenario is zero. You're basically trading in. You're not paying it on a monthly basis. You're paying it upfront one time. Okay, so how does the math work out in our same transaction? We have a $200,000 home. Our same 5% down payment is $10,000. Now at the closing, we also need to pay our upfront mortgage insurance of 1.7% in this example, which would be roughly $3,200. Our principal and interest payment is $948 per month. And then we're not paying anything for the monthly mortgage insurance because we've already paid it up front, so the total payment is $948. The next one, again, this is a common one where folks say, hey, my loan has no mortgage insurance. So what we do is we have what's called lender-paid mortgage insurance. The trade-off for this is you're going to have zero upfront mortgage insurance, zero monthly mortgage insurance, but you're going to have a higher interest rate. All right. In our same example scenario, $200,000 purchase, 5% down. The principal and interest, because the interest rate is going to be about 0.5 to 0.75% higher, your principal and interest would be $1,020 on this scenario. So let's compare all three and see how this looks. So on monthly, we've got cash at closing roughly $10,000, a payment of $1,042. The mortgage insurance term is going to be until you reach 78% loan to value. If you keep this loan and make every scheduled payment, you're going to pay roughly $351,000 for this home. Now, if you do the upfront, you've got a larger upfront investment. You've got to spend more money to pay that mortgage insurance one time. Now, your trade-off, you're getting a lower payment. All right, it's lower by $94. The mortgage insurance term is one time. You only pay it once. And your total repayment is about $10,000 less. Then if we do lender paid, same cash at closing as our initial scenario, our monthly payment is higher because we've got a higher principal and interest, and the mortgage insurance term is for the life of the loan. Now it's important to understand this $1,020 paid by the lender, that interest rate is fixed for the entire 30 years. So you end up paying $367,000 for your total repayment for principal and interest. So again, if you have a loan where someone's saying there's no mortgage insurance, well, take a real close look. What you might be getting is a loan that has lender paid mortgage insurance, and your trade-off is a higher interest rate. So which option is the best one? Which of these three, or maybe even FHA, which one is the best scenario? And the answer to that, guys, is really easy. It depends on the customer. Depends on the customer's preferences. What's their financial situation? Some people can't afford this higher payment of $1,020 per month. They have to have mortgage insurance of some form. Other people have additional funds for the upfront mortgage insurance, and they can pay that extra $3,000 upfront. So the important thing is we go through it with the customer, and this is a big part of what I do when I sit down with the client, is go through these scenarios and let them pick the one that makes the most sense for them. All right. So I hope that really helps clear things up for you guys on some different choices of mortgage insurance. As I mentioned last week, don't try to memorize all this stuff. This is to just give you the basics so that you know how the numbers are structured and how they're calculated. Don't try and memorize the mortgage insurance factors. Don't try to memorize the monthly payments, etc. I've got a mortgage calculator that'll help you out. Just plug in to your smartphone www.tinyurl.com/mtg-YCRE, and then that will automatically install the smartphone mortgage calculator, and you can use that to calculate FHA loans and FHA mortgage insurance, conventional loans, conventional mortgage insurance. The calculator will do all the heavy lifting and all the hard work for you. Okay, guys, if you have any questions on mortgage insurance, please feel free to give me a call, 303-809-7769. If there's anything else I can do outside of mortgage insurance, of course, call me as well. Email is great as well, jmassey@castlecook.com. Have a great weekend, and we'll talk to you guys soon.